It's time for your Low Country real estate market update. It's the Brian Beatty Real Estate Show. Brian is one of the top 1% real estate agents in Charleston. Find him online at listingsincharleston.com. That's listingsincharleston.com. Or call him at 843-345-1273. Now, broadcasting from the WTMA studios, here's your host, Brian Beatty.
Good Saturday morning. Thank you very much for joining me. I'm Brian Beatty, your host, and thank you for tuning in this morning. We talk all things real estate here on this program. So over the next hour, we're gonna hit a few different topics, and this is one of those exciting weekends where joining me in the studio, I have kind of amassed a panel of experts, so that if you have questions real estate related, we are here to answer them. So we want you to call in and talk with us. The number for this radio station is 556-1250, 843-556-1250. And again, joining me in the studio, I have Andrew Muller of Mappus Insurance and Bill Sandvig of Movement Mortgage. So we want to answer your questions this morning. We've got some things we'd like to get through, but please, no question is a stupid question. Call us in. We'd love an opportunity to speak with you and see how we can help you out. Thanks for joining me this morning, guys.
Thanks for having us.
Good to be here again, Brian.
So some interesting news passed this week as far as flood insurance goes. You know, we've had you on the program several times, and over the past several months, we've been talking about flood insurance, how it affects us. We've talked about some unfortunate horror stories of people and their flood insurance premiums going from a few $100s to a few $1,000s a year or worse. And then something happened this week, and I wanted you to shed a little light on that. Can you tell us what happened this week that's important?
Absolutely, Brian. So what happened this week was that the Senate up in Washington, D.C. Actually passed a bill to delay parts of the Bigger Waters Flood Insurance Reform Act. And so essentially what they have passed was for a 4-year delay for homes, pre-firm homes, so older homes that have lost their subsidy when they're bought or sold, that will go away. So this will allow a homeowner to transfer their flood insurance rates to the new buyer. So that's the first big thing that was very huge. Mm-hmm. Number two was that when remapping comes out next year, that if you get remapped into a higher hazard flood zone, that you will not see an increase in your premiums. So that was another huge thing.
Right.
But this is only passed in the Senate so far. It still has to go through the House, and then the president has to sign it into law.
Okay.
The House is going to be tough to get through, and the Obama administration has already said that they're against any sort of delay. So this is not going to be a walk in the park to get this passed. A lot of people out there have been calling our office saying, hey, we've heard that flood insurance reform delay has passed, so does this mean we're good to transfer policies? No, that's not the case. Even if it does pass in the House and the president signs it into law, we're still very clueless as far as in the insurance industry is how this is actually going to happen and occur. Mm-hmm. So there are a lot of unknowns so far, but it has been passed in the Senate. Okay.
I have a property that I have listed for sale in West Ashley, and we had it under contract. An interesting house. It was about 40 years old, and maybe a little bit more. And the home was built on a crawl space, but the garage, which was then refinished, is on a slab. So when they came out and they looked at it, because you can't assume flood policies as of right now, and they did a new elevation certificate, they had to rate the home as though the entire home was built on a slab. And that drastically increased the flood insurance premium that the new buyer was going to pay. And it actually increased so much so that the buyer couldn't get past it, and the deal didn't happen, which is unfortunate. And when I was looking at the quote that was provided to me by the buyer agent, which actually came from Andrew's company, Mappus Insurance, one of my questions that I had was, if I'm looking at this quote and here's a deductible for $1,000, and that's going to result in, X on an annual basis for flood insurance, but then there's also a $5,000 deductible, which significantly lowers the annual premium. And I went to Andrew and I said, this would be a good topic to have on the program because I don't think a lot of people understand their deductibles as it relates to flood, wind, hail, fire, earthquake, all of that. So if you wouldn't mind, take a little time to explain to us how deductibles on insurance policies work.
Absolutely. So this is probably the most misinformed part when it comes to homeowners insurance, flood insurance, wind insurance, earthquake insurance, and there are essentially 4 different types of deductibles out there. There's your standard flat deductible, that's a set dollar amount, either $1,000, $2,500, and then there are also percentage deductibles. Now, homeowners will almost always, here in the Low Country at least, find percentage deductibles for their wind or hurricane deductible. So there are the 3 types of percentage deductibles when thinking about wind or hurricane insurance, and that is a wind and hail deductible, a named storm deductible, and a hurricane deductible. And it's extremely important to understand what you have. So anybody listening, everyone that's listening, pull out your insurance policy, dust the dust off of it, and figure out what you have, because this is a big risk for you if you have a wind and hail deductible versus just a true hurricane deductible.
Right. And if you have questions, you're listening right now, give us a call in the studio so that we can answer that. 843-556-1250.
Okay. And so to give some examples, if this is how I always explain it to people, and I feel like the light bulb always goes off in their head. So say that you have a $300,000 replacement value on your home, and you have a 3% named storm deductible, or a 3% hurricane, or a 3% wind and hail. How does that differ? Well, say that a regular storm rolls through town. It's not a hurricane, it's just a regular storm. Tree falls on your house. Well, if you have a wind and hail deductible, you have a $9,000 deductible. But if you have a hurricane deductible, then that regular old storm doesn't fall under the hurricane, so then you revert back to your standard flat deductible, which is probably $1,000. So you could be looking at a $9,000 deductible versus a $1,000 deductible on the same claim, just depending on the wording of what type of deductible you have for wind or hurricane or a named storm. So that's very important. A lot of times, policies that are wind and hail deductibles are going to be less expensive. So that's what a lot of people kind of steer towards whenever they're looking at various quotes. But they need to understand what it is, because they might not be able to afford a $9,000 or plus deductible just for, a tree falling on their home that they went with that quote because it looked good.
Right. So on Wednesday of this week, obviously we had ice, which doesn't happen in the Low Country very often. And before that, I know at least at my house in Mount Pleasant, we had some hail. So let's say that hail battered on the roof, and you have some torn shingles, and you want to go and you get your roof inspected, and the roofing company says you should file a claim with your insurance company to see if they can, get you some money to fix or repair your roof or put on a new roof. What's your thought on that? What's the thought of kind of taking a situation, and maybe the roof isn't so bad, but you file a claim with your insurance company to see if you can get some money from them to put on a new roof? Is that going to hurt you more in the long run than it's going to help you?
Certainly. You certainly want to think about what the potential return you would get on a particular claim, because it absolutely can have a negative impact if you just notify your insurance company of a claim, as well as if you do end up filing it and receive money in return. Mm-hmm. A lot of times, again, sticking with deductibles, we always recommend higher deductibles. One that you can still afford should a claim happen, but one that you can also, withstand, and hopefully that will bring your premiums down annually. But what it does, by having, say, for example, a $2,500 flat deductible on all other type of claims, you really want to be careful because if you try to say that you file a claim that's $3,500, well, you got to take your $2,500 deductible out, and then you're only getting $1,000 in return. And then for the next 3 years, your insurance premiums could increase 20, 30, 40%. So you sometimes end up paying for that claim 2, 3, sometimes 4 times over. So you just really need to be careful with what you're actually wanting to get out of it, because you would actually do better in the long run by not filing a claim.
Gotcha.
Andrew, you mentioned the 3 different types of storm deductibles. How would you rank them in level of coverage? I mean, what's the most conservative, gives you the most coverage? What gives you the least amount of coverage?
Sure. So a hurricane deductible is what I try to recommend and push our clients to, because that's the least broad of all the deductibles. Less events, less type of claims are going to fall under that deductible. Clearly, a hurricane deductible is specifically for hurricane-related events. And, knock on wood, we have not had a hurricane here for the last 25 years since Hugo that's actually hit the low country. And so when you have a hurricane deductible, you're not going to have as many things fall under it. The wind and hail deductible is going to be the most broad deductible, because any sort of wind or hail type of claim will fall under that deductible. It doesn't have to be hurricanes certainly fall under that, but any type of wind claim would fall under it. And so you are more susceptible to experiencing a claim that has a higher threshold on your part. So again, with a 3% deductible on a $300,000 replacement cost home, that's $9,000 for any storm that comes through and blows a tree on your home. You're responsible for that first $9,000, and that can be a large chunk of money.
Again, we're talking with Andrew Muller of Mappus Insurance here on the Brian Beatty Real Estate Show. If you have a question, give us a call. We're in the studio, 843-556-1250. Andrew, there was something else that I wanted to ask you about as it relates to deductibles, and it's the South Carolina Catastrophe Savings Account. We had talked about this off air a little bit, and I just thought it was an interesting concept, and I wanted you to tell our listeners a little bit about that.
Yeah, this South Carolina Catastrophe Savings Account is something that many people do not know about. I don't really hear a lot of insurance agents talking about it, but it's a really big perk for homeowners to take advantage of. And it's what it is that you take your wind and hail or your hurricane deductible and say again that it's 3% on a $300,000 home. That equates to $9,000. So you can put twice your wind and hail deductible up to $15,000 in a savings account that's South Carolina tax-free. So you're saving 7%, and you're also able to earn interest on it. And this deductible or this savings account that's sitting aside is used for any sort of catastrophe type of claims, any sort of disaster relief going towards paying that deductible down for your homeowner's insurance.
Very cool. Well, you're listening to the Brian Beatty Real Estate Show. Coming up next, we're going to speak with Bill Sandvig of Movement Mortgage. We're going to run a rent versus own scenario, and we have a property that we want to take you through. We want to show you the numbers. So tune in, and if you're in the car or you're listening, feel free to give us a call, 843-556-1250 here in the studio, and we'll field your call. This is the Brian Beatty Real Estate Show on the Big Talker, 1250 WTMA.
Visit Brian Beatty's website at listingsincharleston.com. The Brian Beatty Real Estate Show continues next on the Big Talker, 1250 WTMA. Expert news and views on the Lowcountry real estate scene. The Brian Beatty Real Estate Show on 1250 WTMA.
Welcome back. This is the Brian Beatty Real Estate Show here on the Big Talker, 1250 WTMA. I am joined in the studio this morning by Andrew Muller of Mappus Insurance and Bill Sandvig of Movement Mortgage. And we'd like to take your calls. We are in the studio. Our number here is 843-556-1250. You've got a real estate guy, an insurance guy, and a mortgage guy. So no question is too broad for us. We can answer it, and we'd love an opportunity to speak with you. Off air, we were, if you're just joining us, the last segment we were talking about different types of deductibles for insurance, wind and hail coverage, flood coverage, so on and so forth. And Andrew, you said something that I think was pretty profound, and I'd like for you to just repeat that because I think it's worth saying again.
Absolutely. So a lot of times we'll sit down with clients and go over deductibles when they're purchasing a house. And one of the things that we always get is that, well, we're trying to get the lowest premium so we can qualify for our loan closing. Mm-hmm. And yet they want to take the insurance policy that has the highest percentage wind and hail deductible, typically a 5% deductible. And so I'm sitting here thinking, wait, you want to take a 5% deductible on a $300,000-$400,000 house, so that could be $15,000 to $20,000, yet you're trying to get the lowest possible premium just so you can qualify for your closing. And to me, that's a red flag saying, okay, these people don't have $15,000 to $20,000 set aside to pay for a deductible. So from my standpoint, I have to sometimes say, look, we cannot do that. You're putting too much risk on yourself and on your family and on your finances just so you can close on this. I think we might be able to work some way around it, but that's something that people really need to think about. Can we afford the deductible?
And Bill, I want to move over to you on that. As a lender, are you underwriting folks and looking into the deductible that they're selecting for their insurance policy to say, well, okay, because you look at their bank account, you look at them financially, and if they just have enough to pay for their down payment and that's it for their cash reserves, yet they want a wind and hail policy with a $20,000 deductible attached to it, where does a lender step in on that and say, we need to have a discussion about this?
It's kind of a gray area right now. It's really, we use the phrase underwriter discretion. So as long as the insurance policy is meeting the intent of the policy and protecting the asset and protecting that collateral, then we're going to accept that insurance. FEMA has a little bit clearer definition about deductible requirements, but in this case, it's really underwriter discretion.
Interesting. I just thought it was an interesting thought because people, obviously the goal with any insurance policy is to pay as the smallest amount you can.
That's probably a great opportunity to talk about that savings account, the South Carolina savings account for deductibles. So.
Right. Well, anyways, we are in the studio taking your calls, 843-556-1250. I want to move on to the age-old question of, do I rent or do I buy? And Bill and I have been talking about this a lot because the affordability of properties in different areas of Charleston, I think it's still highly affordable, especially when you look at it compared to our rental market. And I know that you have some numbers that you want to walk us through, and I'm going to turn it over to you. Before I do, if you have any questions, we'll stop what we're talking about, 843-556-1250.
Thank you, Brian. So just this week, I had a client come in, and they asked me that very question. I've been a habitual renter, and I'm thinking about making a purchase, and talk to me about my options. Mm-hmm. So it looks like we got a caller.
Yeah, Bill, we're going to move over to Marie in Mount Pleasant. Marie, are you in the line?
I am.
Thanks for joining me this morning. What's your question?
Well, I have. I just heard your segment, and now I'm very interested about the name Storm because I have a policy with USAA, and it's the South Carolina Wind and Hail.
Okay.
Okay, and I also have flood insurance because I'm in a condo in Mount Pleasant. So that's already taken care of. But I think in this wind and hail, it doesn't say anything about a named storm.
Okay.
It just says personal property, $50,000, loss of use, $20,000, policy fee, whatever that was, or $400, whatever that.
So you're in a condo?
I am.
Okay. Andrew, I'm going to let you take this one as the insurance guy.
Sure. Well, Marie, it's a great question. So you're with the South Carolina Wind and Hail Association for your wind and hail coverage.
Yes, sir.
And so that would fall under a true wind and hail claim. So any sort of wind and hail claim that happens is going to fall under that type of policy. Okay. And some things to know about the Wind and Hail Association is that the association policy, that was formed as a last resort market. So you're you really want to try to get out of the wind and hail association. And a few reasons for that. Number one, the rates are extremely high. Mm-hmm. And number two, contents coverages, your contents are rated as actual cash value versus replacement cost. So that's something that you really have to think about. If I had a loss, what am I actually going to receive in return? What am I paying for?
Right. Yeah, great information.
With the wind and hail, though, hurricanes, named storms, they all fall under the wind and hail.
Correct. They all fall into that. But that deductible that you have, it's probably a 3% deductible. It's going to be all encumbersome with any type of wind and hail claim. So yes, hurricanes, named storms, they all fall under that deductible. And so you are most susceptible to any sort of wind and hail claim with that policy and deductible. But again, contents are covered on an actual loss sustained basis. And so you won't receive the full value in return as you would for a typical homeowner's policy where if you have something damaged, then they'll replace it.
Right. Oh, gosh. Thank you so much for this information. I definitely will be calling them on Monday.
Thank you very much for the call, Marie.
Yes, sir. Thank you. Bye-bye.
Again, we're in the studio. We're taking your calls. The phone number here, 843-556-1250. Bill, I wanted to shoot back over to you we can talk about our rent versus own scenario.
Thank you, Brian. So the customer came in, was looking for the age-old question, should I rent or should I own? And we talked about their budget, what they were looking for in a house, and he was looking for a house out in West Ashley. And so we went on to Craigslist, and we looked at some rental properties. And we found house rentals with his needs of like 4-bedroom is what he was looking for. And the rental prices for a 4-bedroom house in West Ashley were anywhere from $1,700 to $2,000. So if we were to compare that to a couple of houses that were for sale, and I asked you, Brian, you got anything for sale in that area? And you showed me a particular property. And tell me a little bit about it. It was 2808 Limestone?
Yeah, 2808 Limestone. The owner bought it, did an entirely new renovation to the property. Everything in there is brand new, from the anything from fixing the foundation to new roof, new everything. And we have that listed for $259.
Okay, so
it's 2,200 square feet, 4-bed, 2-bath in Drayton on the Ashley.
Yeah, beautiful home.
So $259, and I took that house and I ran the numbers for it, and we came out with, knowing that the buyer was only looking to rent for the next 2 years, what would he do if he was to buy for the next 2 years before he was relocating? So the payment on the property for a $260,000 purchase, after we factored in taxes and insurance and any fees he might have, the total payment on the house came out to $1,750. That was with a minimum down payment for an FHA loan of only $9,000. So with $9,000 down, he walked away with a $1,750 payment. Compared this to rent in the area of a conservative $1,700. And if you just do the math, $1,700 for 24 months, it was going to cost him $41,000 to rent a similar house. Now, buying that house with where the market is, we're seeing improving market values. What was, just year over year, Brian, how much has the local market improved in house value?
Well, Tri-County, about 10%.
So 10%, if we were to really be conservative with that and assume that maybe it's only a 5% increase in house value from this year to next year and the year after that, that would result in an increase in equity on this home of $47,000 in those 2 years. So buying that house over 2 years, a potential increase of $47,000 in equity. There's a couple of really strong points to talk about when you buy a house. Obviously, when you make that payment, you're getting principal. When you make that payment, you get tax savings on the interest. So the tax savings, the equity you're putting into the house, the increasing house value resulted in, over that 2-year span, in this case, for this house, he would have made $9,000 to live in that house for 2 years. Spend $41,000 or make $9,000 over 2 years. That's a $50,000 difference.
Wow.
Significant.
Pretty impressive.
It didn't take much for him to question whether he should be renting or owning in that case.
Sure.
Looks like we've got another caller.
Yeah, we've got another caller on the line. Tom from Mount Pleasant, you there?
Yes, I'm here. Good morning.
Tom. Good morning. We've got about a minute before we take a break, but go ahead and shoot us your question, and we'll answer.
All, guys, great show. It's very informative. I'll try to make my question real quick. In a few years, my wife and I, we're going to be empty nesters, and we have a bunch of equity in our home right now, so we're considering selling and maybe renting and stocking away the equity that we have. Because, look, taxes keep on rising, repairs are rising, insurance is rising. The problem is that we really love our home, and we're debating whether we want to sell or should we move, okay? So I guess my question is do we downsize? Should we get an equity line from a bank for future repairs and expenses, or should we just simply downsize?
That's a great question. Bill, do you want to talk about that first?
Well, one of the things that pops to mind when people talk about retiring or downsizing in a house, especially in sounds like your situation where you've got a good bit of equity in your home, is the opportunity for a reverse mortgage. Now, if we're talking about renting or buying, one of the key things that people will bring up in the retirement years is the simplicity of renting. You don't have to worry about maintenance and things like that. But from the financial aspect, taxes, insurance, all those things, you're paying for that whether you're renting or you're buying, because you can rest assured the landlord is factoring in the cost of taxes and insurance into your rent. Mm-hmm. So you're not going to really avoid paying those things by renting. Okay. In this case, financially, a reverse mortgage would allow for you to expend a little amount of the equity that you've built in your home and still have no mortgage payment. So it really frees you financially by not requiring you to make that monthly bill. And it also keeps as much of the money in your bank account as you possibly can, but still maintain ownership.
Work?
So basically, if you have 50% equity in your house and you're past the age of 62, you can qualify for a reverse mortgage. There's no income requirements, no credit requirements. It's just purely based on equity. So when you say you were buying downsizing to a $300,000 home, instead of paying full cash for $300,000, you could pay half of that amount, or $150,000, and still have no mortgage payment. So that way you've saved that $150,000 and left it into your retirement savings. I hope that helps, Tom.
Tom, you still on the line with us?
Yeah, I'm still here. I'm sorry I couldn't hear you.
Oh, that's okay. Did we answer your question?
Yes, you did. Thank you so much.
Oh, thank you very much for calling in. We appreciate it. This is the Brian Beatty Real Estate Show. Again, if you have questions, give us a call, 843-556-1250. You're listening to the Brian Beatty Real Estate Show on the Big Talker 1250 WTMA.
Hear the Brian Beatty Real Estate Show every Saturday morning at 8 on 1250 WTMA and WTMA.com. 1250 WTMA. Now, here's more of the Brian Beatty Real Estate Show on the Big Talker, 1250 WTMA.
Thank you for joining us. This is the Brian Beatty Real Estate Show here on the Big Talker 1250 WTMA. If you're just tuning in, we are in the studio live. I have Andrew Muller of Mappus Insurance and Bill Sandvig of Movement Mortgage here fielding your calls. So if you have a question real estate related, give us a call. The phone number here is 843-556-1250, 556-1250. The first part of the show, we talked about deductibles, understanding your insurance deductibles, and we've had some questions about that. And then we transitioned over to Bill, who kind of took us through a scenario of a home that we found in West Ashley. It's actually my listing, and we ran a scenario on what it would cost to own that home versus what it's going to cost you to rent that home. And ultimately decided that it was more financially advantageous to purchase it rather than rent it when you look at the savings and the earnings through equity versus just throwing money away in rent. Now, there are obvious benefits and disadvantages to renting and owning. It'll just be up to you and your individual situation. We had Tom call in, and we ended up talking about a reverse mortgage, which I think is a very interesting concept and something that we really haven't covered on this program. But Bill, I wanted to go back to you because I wanted to talk about affordability in our housing market right now. You know, we're at a point where prices are starting to rise in many areas, and in many areas they've risen so much so by close to 10-12% in some areas. And so if we look at just the market in general, and we have low interest rates, affordable housing prices, and high rent, I just wanted you to talk with us a little bit, because I know you've got some information for us on home affordability, which I think you got from the National Association of Realtors.
So housing affordability is an index that is tracked, and basically what the housing affordability index is it measures how qualified the average American is to buy the average home. So it's a simple formula of the median income across America and the median household across America. And if the income is exactly what is required to qualify for that average house, then the index would be 100. So if income is low and housing prices are high, that index will slide down. And we've seen back in the 80s and 70s when interest rates were very high and housing prices were starting to go up, that number was down in the 60s and 70s. Typically, it hovers right around 110. So just a little bit better than that equal threshold. The last 3 years, we were up at 200%. So 200 was the housing affordability index. Right now, we are at 175. So because we've seen that increase in interest rates, because we've seen housing prices start to recover, that number is sliding down. As rates go up, as housing prices go up, it's going to continue to slide down back to what we've seen over the last 30 years. But right now, it has never been more affordable to own a home. And that is why when we do this rent versus own comparison, that just about in any situation, we're going to see right now it makes more sense to own. And people have talked about it. I've heard it. You've probably heard it. Rent is going up. If you're renting a home, you're spending more money on it, and landlords are getting more money for it.
Right. You know, it's interesting when I work with a lot of investors, and I have for a long time, from 2009 until parts of 2012. It's almost all of what I did was help people buy and sell foreclosures and short sales. So I understand that market incredibly well. And although that market has changed over the past 12 months to where, you know, if we looked at the market in 2012 versus 2013, distressed inventory reduced by 18% is the number. So the active amount of short sales and foreclosures out there really only represents about 10% of our market. And that's not a lot. So 1 in 10 homes is a distressed sale. It used to be much higher than that. And when we look at purchasing these properties with the idea of renting them, obviously back in 2010, as an example, prices were much lower. Rents were still pretty good, but they're not as high as they are now. So if you look at the cash-on-cash return that you could get by purchasing one of these investment properties, it was over 10% in many cases. That has started to slide down now that pricing is going up. Rent has done a good job of staying relatively high and you know, year over year kind of bumping up a little bit. We have more renters than we did back in 2008, 2009, because a lot of people got foreclosed on or they got a short sale done and they can't buy unless they pay cash, and most of them don't have the ability to do that. So from the standpoint of affordability, it really is a fantastic time to look at purchasing or investing, because the great thing about an interest rate, especially if you get a 30-year fixed, is that it's fixed. It's not going up. So I just think that for right now, in this market we're in, we're kind of in that perfect storm where prices are about to start rising, interest rates are about to start rising. Everybody's talking about it, and if everybody has agreed mentally that interest rates are going to go up, then that's really all the market needs to go ahead and take that jump, in my opinion, and start rising interest rates, right? So now's a good time to lock in. And if you look at some of our markets where we still have a lot of distressed inventory, or we still have some inventory that is such that it's not a seller's market, it really is a fantastic time to buy something at 2011 pricing. It just depends on the neighborhood. And that's why I always say when people call in or we speak about scenarios, what should I do? It is so specific to the price range that you're in and the location that you're interested in. Real estate is and always will be a hyper-local subject. So it just depends on what you're looking for. Again, we're in the studio with Bill Sandvig of Movement Mortgage and Andrew Muller of Mappus Insurance. And we want to take your calls, 843-556-1250. I have a listing in downtown Charleston on Rutledge Avenue. And I asked you to take a look at this for me and just run some numbers. It's a triplex on Rutledge Avenue. It's listed for $1 million. And just some interesting things to note about this property. It generates $5,700 a month in rent, and it's beautiful view of Colonial Lake. The way it's set up is the first floor, or the top floor, used to be where the owner lived. So it's much more renovated than the other 2 units downstairs, which he just rented out. And what I'd like for you to do is just run through a quick scenario, because we only have about a little bit of time before we take our next break. But let's say that someone wanted to purchase that property, live in one of the units, and rent out the other 2. What would that look like for them? It's talking about affordability.
So because rent is so high, and because, $5,700 a month in rent is what you're getting out of this property right now. For 3 units, that's powerful. So once you get past the down payment requirements for this size home, you go on to the debt to income or required income to qualify. When you're qualifying for a house with multiple units, you can actually use the projected rental income to qualify for that loan. So if you have, throwing out any other variables like car payments or things like that, if we were to qualify you on this house, you could have an income as low as $95,000 a year. A household income of $95,000 a year or more could possibly qualify you for this house. That's because even though it's a $1 million home, you have $5,700 of additional income coming in on this property. It's kind of eye-opening to think, oh my goodness, a family earning $100,000 a year could buy a $1 million home. Yeah,
very interesting. Mm-hmm. We're going to take a quick break. When we come back, I want to talk to you about for sale by owners, expired listings and withdrawn listings. It's that time of year. So stick with me. This is the Brian Beatty Real Estate Show here on the Big Talker, 1250 WTMA.
More stimulating talk on real estate matters with Brian Beatty next on 1250 WTMA. You're listening to the Brian Beatty Real Estate Show on the Big Talker, 1250 WTMA and WTMA.com.
Welcome back. You're listening to the Brian Beatty Real Estate Show here on the Big Talker, 1250 WTMA. Thank you for joining me this morning. This is our last segment. If you are just tuning in, I'm in the studio with Andrew Muller of Mappus Insurance and Bill Sandvig of Movement Mortgage. And we've been taking some phone calls, talking with people about their real estate issues and helping them so that they can make some informed real estate-based decisions. Andrew, I wanted, first and foremost, to just say thank you very much. You've been on our program a lot and have helped educate my clients and our listeners on all things insurance-related. So thank you for coming in. Give us about a 60-second recap of what we talked about for those that are just joining us that kind of missed that first segment, which was a very important segment. And again, if you're listening in, we have a few minutes left. 843-556-1250.
Absolutely. So for those that didn't hear the first segment, the flood insurance delay is about 70% there. So the Senate up in D.C. has passed a bill to delay pieces of the Bigger Waters Flood Insurance Reform Act, which will inevitably delay the flood bill for 4 years and allow for subsidized rates to be transferred to new buyers and allow for homeowners that get remapped into a higher hazard flood zone to not experience rate increases. Again, it still has to go through Congress, and it still has to be approved by President Obama. The second thing we talked about were deductibles. It's very important to understand what deductibles you have on your homeowner's insurance policies, specifically as it relates to wind and hail. It's typically a percentage deductible. You need to know what percent, and is it a wind and hail deductible, named storm deductible, or a hurricane deductible, and see if your family can actually withstand a windstorm loss. And then the last thing we talked about was the South Carolina Catastrophe Savings Account. This is something that's talked about very little. I encourage everyone to Google South Carolina Catastrophe Savings Account. This is the ability to save money in a savings account, earning interest, and tax-free for your South Carolina income tax. And it will go towards paying down any deductibles as it relates to catastrophes that occur here in the state of South Carolina.
You know, we actually just got a call. Walt in downtown, he wants to know about the homeowner savings account. Walt, are you on the line?
Yeah, I am.
Thank you very much for calling in. We appreciate that. What question do you have for us?
The state tax credit thing for insurance, can that apply to investment properties as well, or is that strictly for homeowners?
That's a great question. To my knowledge, it applies to any property. As long as you are the owner of that property, then it will apply to it.
Oh, really?
Yes.
That's good. Okay.
And again,
can I ask one follow-up question?
Sure.
I've qualified before for this tax credit that you can get on your state income tax if you pay more than 10% in insurance premiums on your homeowner's policy. Is it one of the other things, or is this?
No, I think this is different. This is a savings account that you can place money into up to twice your deductible, up to $15,000, and you're just able to defer that South Carolina income tax, and roughly 7% would be tax free. But as far as what you're talking about, I believe that's just more of a accountant tax related question that I cannot answer.
All right. Well, listen, how do I find out more about setting up one of these accounts? It's
very easy. You can go to any local bank or federal bank, and everyone that's here in the state of South Carolina can set it up for you. It just has to be named and approved for the South Carolina Catastrophe Savings Account. It's very, very simple. Just go to your local bank. I would say almost every single bank has this account set up, but just no one ever talks about it.
Okay, and it has to be a savings account, not like a money market account.
Correct. It has to be a savings account.
Okay. Well, listen, thanks so much.
You're welcome.
Appreciate it.
Thank you very much, Walt. So, Bill, moving over to you, give us a little bit of a recap on what you talked about, because you had some very interesting points.
Sure, Brian. We talked a little bit about rent versus buy, and even in a short 2-year time frame, how a moderate $250,000 house could end up saving you $40,000 over the course of that 2 years to go ahead and buy. We talked about investment properties and the housing affordability index, and how right now housing affordability is as high as it has ever been in history, and that means that your mortgage payment and that house price is as affordable as it could possibly be. Rent is going up, and it's a good time to buy. Good time to be an investor. We talked about 60 Rutledge Avenue and how affordable it could be to actually get into a $1 million investment property. And I just wanted to share one point that I didn't share before. Little known, FHA. It's only used for primary residences, but you can actually buy a multi-unit primary residence. You can get up to almost $700,000 loan for an FHA loan, where in a 4-unit property with only 3.5% down, be moving into that property. So a $700,000 house, 20% down, 4 units. You rent 3, you live in 1, and it's a pretty powerful way to go.
That's awesome. Well, thank you both very much for joining me this morning. I really enjoy getting up and fielding questions and helping people with their real estate needs. If you'd like to connect with me, if there's something that we talked about you'd like more information on, go to my website, listingsincharleston.com, or call me at 843-345-1273. and that website will have Bill and Andrew's contact information as well. Again, thank you for joining me. You're listening to the Brian Beatty Real Estate Show on the Big Talker 1250 WTMA.
Join us for another edition of the Brian Beatty Real Estate Show next Saturday morning from 8 till 9. Contact Brian Beatty online at listingsincharleston.com. That's listingsincharleston.com. Or call him at 843-345-1273. 843-345-1273.